Hello everyone, welcome to the first episode of the Doogie Show. In this episode, we will be going over my portfolio positions and goals for the future of my investment portfolio. Then we will be going over my current positions and analyzing the biggest position in my portfolio, VICI properties. We have a lot to get into, so let's jump right in. So, these are my current financial goals for this portfolio. We will be using this going forward to analyze the success of my investment strategy and saving strategy, which we will go over in a future video. As we can see, by January 1st, in about 8 months, I plan to have saved $50,000, and then a year from that, my goal is to reach $100,000, essentially increasing my net worth by $50,000 every single year. Now, this is my current portfolio, which is worth roughly $30,000. The left graph shows the overall equity of my portfolio, and the right graph shows the difference in value if I hadn't invested versus current value. The light blue line is the money that I put into the account, and the dark blue line is the money that I invested plus any capital gains and losses. As we can see, over time, my investments have made me more money overall by about $8,000 to $9,000. By the end of this year, my goal is to have an investment account with $50,000 worth of equity in it. These are my current positions. As we can see, my biggest stake at about $28,000 is VICI, and since entering this position roughly a week ago, I have lost about $1,300. My cost basis is $29.54, and the value of the stock has decreased to $28.20. Aside from that, I have a very minor position in Monster Energy, only being worth about $30, and a slightly more significant position in SoFi, at about $1,000 worth of equity in that company. The SoFi position is in my Webull portfolio, not my Fidelity portfolio, which is why it doesn't appear on the Fidelity portfolio. In total, my investments are worth roughly $29,000. So this means that my portfolio, either by my investments increasing in value or by putting more money into my account, has to grow roughly $21,000 in the next 8 months in order to meet my financial goals. So this is how I like to track my finances. I like to set goals for myself roughly every 6 months and evaluate after that time period. This makes it easy to track and reform your personal habits in order to reach any financial goal. In a future video, I will go more in depth on how I make my own financial goals so you can create and adjust your own financial goals. Now, VICI Properties is the biggest position in my portfolio, valued at $28,000. And now I'm going to give my thesis on why I believe this company is one of the most undervalued companies in the market right now. I entered into this position about a week ago, right before the inflation report came out, which quickly caused my position to lose money. However, I am still very bullish on this company and its future growth over the next 2 to 5 years. VICI Properties is a real estate investment trust that owns and operates a wide variety of top-of-the-line experiential properties in the United States and Canada. They own a large portion of Las Vegas along with many other properties. Their portfolio of market-leading properties is the largest in its industry, owning 93 total assets including Caesars Palace, MGM Grand, Venetian Resort, and operating over 60,000 hotel rooms. This company is one of the biggest real estate investment trusts in the world, with world-class destinations in Vegas and all over the United States. Their diverse portfolio allows them to properly capitalize on the revenues of not only casinos in Vegas, but also many restaurants, golf courses, bars, bowling alleys, and more. This is important because it is important to understand what a company does in order to understand why and how they make money. For VICI, the biggest part of the real estate portfolio is in Vegas, so the success of Vegas is a big part of the revenue, and Vegas is only becoming a more renowned destination year after year. These are the earnings of VICI over their lifetime. Full disclosure, I got this graph off of Simply Wall Street. VICI financials indicate a very profitable business model that continues to become more and more profitable over time. Their latest earnings report reported $3.6 billion in revenue and $2.6 billion in profits. These numbers are getting higher exponentially over time, while their operating expenses continue to get lower. This indicates a very flexible business model that doesn't require a large amount of management to make money. Their consistent increases in revenue seems to imply a very successful business model that will continue to make more and more money going into the future. Based on this graph, there aren't any real problems with their earnings over time. This is a big green checkmark in the earnings category. However, despite having massive increases in revenue and profits, their stock isn't reflecting it in its growth over time. In the last 5 years, the stock price has only increased 22%, despite the revenue going up roughly 300% and their profits going up almost 400%. This is seen even more in their previous year of performance. As we can see, their stock price has gone down 14% in the last year, despite the revenues going up 38%, and their profits going up 127%. So why is this company not going up in line with its increase in profits? Well, the first alarming thing for this company is their debt. They are currently in $16.7 billion worth of debt, and this number has been increasing over time. Obviously, their equity has been increasing with it, but companies that continue to take on more and more debt over time can be scary for investors. However, it is important to understand that this is a real estate trust. So when they buy new properties, it makes sense that they would incur loans to afford this new real estate. However, the debt-to-equity ratio is still high at 65.2%. But their profits and revenue are also growing, meaning that they are very capable of paying this debt off going forward. It is just concerning to see a company in so much debt that continues to take on more. Another big problem for VICI is rising interest rates. Interest rates being high continues to be a major problem for VICI's stock price. VICI Properties is in a uniquely bad position to deal with high interest rates. Not only do high interest rates incentivize high-yield savings accounts as an alternative form of investment to the stock market, but as a real estate trust, anytime they buy a new hotel, a new restaurant, golf course, etc., they will take out a loan to purchase the property, as discussed previously. And unfortunately, high interest rates mean more expensive loans, which have the effect of reducing the return on capital employed for VICI. This is the main reason VICI stock has massively underperformed the market in the last year specifically. These interest rates are not only drawing investors away from the stock market, but also hurting VICI as a company. This is why the inflation report this quarter not reducing inflation rates caused the stock price to nosedive almost 7% in one day. Now, the culmination of the current economy has caused a massive undervaluing of VICI stock. The company is priced at a price-earnings ratio of 11.7% and the forward price-earnings ratio of 10.6%. These numbers are customary of companies that have little growth. However, in the last 5 years, despite their stock barely reflecting this increase in profitability, they have grown about 74% year over year. However, as discussed, high interest rates make this company look like a poor investment in the short term. Interest rates aren't projected to be lowered until November. However, this dip could serve as a great buying opportunity. They have high debt, but it's manageable. Moreover, not if, but when the interest rate gets lowered, their debt obligations will also be lowered, and their stock will look like a much more prosperous investment opportunity. When this happens, the stock will see explosive growth in price. Not only that, the company financials are very strong. They are currently priced at a growth rate of 10% this year, and they have done a great job of beating earnings historically. The company is both a good company that will continue to produce increasing revenues and profits, and massively undervalued. This is a great opportunity to get into the company that will continue to grow year after year. The only word of caution about this company is that it may take some time for the stock to rebound. As stated before, interest rates aren't projected to be reduced until November of this year, and in the short term, the stock could continue to sell off. However, I see this as an excellent opportunity to buy into the company at an extremely advantageous price. Finally, we have to look at the elephant in the room, the Fed. The Fed, in their latest inflation report, stated that inflation is still not under control, and because of this, they will not be lowering interest rates. On the contrary, there may actually be a possibility of rates being heightened. If inflation doesn't get better in the coming months, this would cause VICI to sell off even harder. However, interest rates and VICI's stock price have no effect on the long-term profitability of VICI as a company, so the stock price will most likely recover and some in the next 2 to 5 years. This is an excellent company, priced at an extremely discounted rate. The only thing is, it could take almost a year for the stock to actually reflect this if the interest rate continues to remain high, so in the short term, the stock may continue to sell off. But this is only, in my opinion, an opportunity to buy even more stock. Thank you so much for watching till the end. I plan on making portfolio updates every week and other videos pertaining to personal finance, including stock analysis, news, investment strategies, options, crypto, and more. If you would like to see anything specific, let me know in the comments down below, and don't forget to subscribe for more.